Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I'll be your host today. And really excited to have Devin Elder with us today. Devin is the founder and CEO of DJE Texas Management Group. They're a vertically integrated investment firm based in San Antonio. He's also the host of a really great podcast, the DJE Podcast, and he's the founder of the DJE Foundation, which is a 501c3 whose mission is to help improve the lives of disadvantaged children. So, Devin, welcome to the show. Thanks so much for being here with us today.
Randy, it's my pleasure. Thanks for having me, sir.
Outstanding. Well, let's jump in with a question I like to ask everybody to kick things off. Can you give me your perspective on the state of the market and how that might be affecting passive investment opportunities or the passive investor as a whole?
Absolutely. I was having a conversation with one of our lenders out of New York in the past couple of months, and we see a lot of deals hit our desk, but not as many as they do, right? They have a bigger portfolio than us. They're national footprint. So I always like to ask, what are you guys seeing out there? And this was probably in the last 6 weeks. And their answer is, well, it's the land of the haves and the have-nots. You know, it's if you're out of capital and you're facing maturities, or you're facing loan extensions, or you're facing rate cap purchases. These are a lot of things kind of impacting multifamily right now. It can get pretty tough out there for the folks that have capital or some staying power. Tremendous buying opportunity. And so, you know, I don't want to be the guy screaming blood in the streets and all this stuff. We never want to see anybody lose an asset or investors get wiped out on equity. But there's two sides of the transaction, and so I think, you know, as an operator, we can't wait for markets to rebound and sell some stuff. I would like to have sold some stuff in 2024. The market just not really delivering that. On the buy side, we're seeing some really, frankly, incredible basis on assets. You know, 50% of what they would have been a couple of years ago, and so.
Wow.
You know, I think the opportunity is there. Of course, the herd kind of moves together. There's a lot of fear in the market too. So raising equity is more challenging than it was a couple of years ago. But the prices are, in some cases, not all cases, in some cases are very compelling. So I think for the patient passive investor, it's a good time to look at getting into deals with a good basis and a good story. And then for deals that they're already in or operating, some of it is just kind of hang on and ride it out. I think the thesis specifically in multifamily investing has always been, in the 12 years that I've been involved, is, hey, we're looking at a 3 to 5 year hold. You want to be in a position that if you run into a rough economy in the middle of that, the game plan is just to hang on and not be a forced seller in a down market. So that's kind of our strategy on some of our assets where, you know, okay, we're not really able to sell this right now, or at least not at a price point that we like. So we're just going to kind of continue to operate it. Fortunately, these assets are often generating hundreds of thousands of dollars a month in revenue to kind of cover at the very minimum, cover your bills. So I think there's two camps, right? There's the deals you're in, and it might be just kind of a hang on and get through, which isn't great, but that's the market we're in. And then on the buy side, or getting into a new deal, I would suspect your audience is probably seeing some really good basis on some new acquisitions. And I don't know how big that window is going to be. I think 2025 presents some opportunities. There's a tremendous amount of capital on the sidelines. And so I don't subscribe to the thesis that, you know, everything's going to be on sale and there's going to be this extended period of discounted deals. There may not be, right, depending on what the market does. But that's the high level kind of from my perspective is I think there's some good basis plays to be had here in the next, call it 12 months.
Yeah. No, thank you for that. And I would agree completely with you, what I'm seeing from my standpoint. And I like to hear kind of your your cautious approach, or maybe it's just more of a level-headed approach to the passive investor, that there are some deals that are struggling. But the beauty of real estate is if you hold on to those assets long enough, and you're positioned in such a way where you can hold on to those long enough because of your debt or your reserves, then everything's probably going to work out just fine if we can sit tight for 2, maybe 3 years. So, yeah, thank you for that perspective. That is, there's a lot of people out there that are running around like chickens with their heads cut off. That they're
Always.
screaming about like the world's coming to an end and everybody's losing money, and we've just not seen the banks want to push it back or take those assets back, which will ultimately put investors in a hard position. So,
Right.
well, very good. Well, let's kind of take a step back if we can, Devin. Can you tell the audience a little bit more about yourself than I did in the very brief intro? You've obviously been operating in the space for 12 years or so, so you've got quite the story. Tell the audience who we're getting to listen to today.
Sure. Yeah, I was born and raised in San Antonio, Texas, where we are headquartered now. So even graduated college from University of Texas, San Antonio. So I'm San Antonio through and through. I had a 10-year corporate career at a couple of larger employers in San Antonio. So I got to experience some marketing and operations and leadership roles in a couple of large organizations that a lot of that served me very well. I think I was pretty hot to trot early in my career to kind of get on a career path. What I found from my particular circumstance was I didn't really have any heroes in the organizations that I worked at. So there was folks maybe making good money, but I didn't necessarily want to model their overall life picture, and I didn't want to be there in 10 years. So that sent me on this entrepreneurship journey. And, I'm a big fan of modeling, right? I think the key to success in anything is to find somebody who has achieved the exact thing you want to do and copy them exactly. That's an
Yep.
oversimplification. It's not easy to do, but it is simple to do. So I started finding mentors and models in real estate that I could copy, joining masterminds, paying for coaching, those kind of things. And this is not a blanket endorsement of every real estate coaching program out there, certainly, but I am a big believer in hiring consultants, hiring mentors, and shortcutting that, assuming you're serious about it. So I did that early on. I started buying houses while at my corporate job, married, 3 kids, a nice 6-figure salary, or six. It was 6 figures was nice at the time. I
Sure.
don't know how much that purchasing power that is today, but at the time, but I had read all the entrepreneurial books, Kiyosaki and Tim Ferriss, and 100 others. Gotten pretty fired up about creating my own little empire. Started going out and buying houses where you could get short-term money at 12%, renovate it, and refinance out. It's kind of the Burr method that's been popularized. So I did
Yep.
that many times, and to make a very long, arduous journey short here, my goal was to have cash flow every month in excess of my bills. And this wouldn't set me up for life, but it would set me up with a foundation to exit my corporate career. So that took about 2.5 years of really burning the candle at both ends. I mean, I would
Okay.
go out to the job site. Well, it was dark out, check in on the progress of a house that was being renovated. I would go to work. I would go to Starbucks at lunch and meet the escrow agent for a house I was buying or selling, sign docs. I would go back to work, get off at 5:30, go back to the job sites for about 2.5 years, just
Yeah.
absolutely um, going, full tilt. And I think that sort of focus was required to achieve escape velocity out of that kind of that comfort of a nice corporate salary. And I think one more promotion in the corporate world and I would not be an entrepreneur. It would have just been
Yeah.
the next level of comfort where it's like, man, I'm, in my 30s, I'm not going to give this up. But never made
Yeah.
it to that next level, was uncomfortable enough to become an entrepreneur. And so that was how that started. And then I had also gotten into multifamily real estate investing at the time, also with a group of mentors, and started to explore that world. I transitioned my capital raising abilities from these single family $100,000 projects into getting into
Mhm.
multifamily. Okay, maybe now it's a $2 million equity. And I'm not going to do it with one partner. I'm going to do it with 15 partners, right?
Okay.
And so made that transition, liked it, and, have gone from a 75 unit to 130 to 250 to today, where, just to rapidly accelerate and fast forward, we manage 2,500 units of multifamily in San Antonio, Texas. And we've got a team of about 70 folks, between corporate and accounting and marketing and the management company, along with a pretty substantial investment in rural land and some flex industrial. So that's been the journey. I think the concept I had when I was working my job and building this rental portfolio was, after I'd done that for a few years and achieved some success, I thought, what could I do if I had my full bandwidth available to commit to this? I'm committing to this at night, weekends, on my lunch
Sure.
breaks, and I'm seeing some success. What if I had all day, every day for the next 5 years to do this? And so made the leap, started that, and the company really kind of hockey sticked, after that. And I would say we're still going at a very good clip. I work a ton. I love it. I find a lot of meaning in it. I
Sure.
work all the time. I'm married. I have 3 children. We, of course, carve out time for some amazing adventures. You know, we can talk about that, but I like to work a lot, and it's really rewarding for me to kind of have the platform now with my company to be able to execute on all these big projects. So I think I
Yeah.
found my calling with entrepreneurship. It's not for everyone, certainly, but it is for me. And the W-2 job just wasn't providing that variety, that stimulation, and that upside that I was looking for, and I found it in entrepreneurship.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Yeah, gosh. Well, that is, that's a story I hear a lot,
Yes.
in this space. It's,
Yep.
it's, people are usually either cut out for corporate America or they're not cut out for it, and they figure it
Right.
out pretty quickly.
Right.
Um, when you look back, that 2.5 years that you spent, kind of burning on both ends, looking at it from today, it seems like it's worth it. But I'm sure at points, you were questioning, and other people were questioning why you were doing that. I'm curious, what do you say to the folks that are kind of still sitting in that W-2 position, and they know they don't want to be there, for 30 more years, or maybe they don't want what their vice president's life looks like?
Right.
What kind of advice do you give those folks?
I think it very much depends on personal temperament. Like I said,
Yeah.
entrepreneurship is not for everyone. And as somebody that is paying the payroll checks now for 70 people on payroll,
Yeah.
be careful what you wish for, right? So I'm
Mhm.
not discouraging entrepreneurship, but your employer is taking a tremendous amount of risk on you, and they're covering a lot of stuff for you, hoping they get some productivity out of you. So I've kind of gone from maybe a disgruntled employee many years ago to, a business owner going, these guys don't know how good they have it, right? I'm taking care of
Right.
insurance, and
Right.
they get paid like clockwork, and they don't have to take any risk. So it really just comes down to temperament, and I think, ultimately it's, what are your goals for your life? And if your W-2 is not getting you on the track to those goals, maybe it's time to look at something different. And, don't let anybody tell you entrepreneurship's easy or a walk in the park. I think there's maybe some influencers out there that are
Sure.
creating some of that sentiment that, hey, we just buy a business with an SBA loan and roll them up, and we're just going to be cash flowing and having drinks on the beach.
Right.
It can be that, but it can also be exceptionally difficult. So
Sure.
to answer your question, I think it comes down to temperament.
Yep.
If you're willing to take the risk and be the entrepreneur, the rewards are unparalleled. But I think the key takeaway there is, if you do commit, you must be all in with every fiber of your soul for many years.
Yep. Yeah. I think, and I was probably guilty of this as well, is I had this idea that, this 4-hour work week ideology that you
Yes.
see everybody talk
Yes.
about. Um, is this magical euphoria or this rainbows and unicorns world where people can just work 4 hours and they're going to make more money than they possibly ever thought they could. Um, that's certainly not been my experience as an entrepreneur.
Right.
Spending 10 or 12 years interviewing entrepreneurs while I was in my W-2, that definitely was not the experience of any of those folks.
Right.
I heard somebody say that you work a ton of hours for very, very little money for a lot of years until you can work just a few years, making a whole lot of money for those hours that you're putting in. And
Yeah.
I think for the entrepreneur, that's just shy of that. The message I keep hearing is don't quit before the magic happens, or inches to gold, that type of analogy.
Yes.
So yeah, I think it's good for a certain type of group that really enjoys their job. They're making very good money, and they just still want to have access to commercial real estate for part of their portfolio. And that's really where folks like yourself come into play, where they can stay in the W-2 and passively invest in opportunities in folks like you and me that are working 80 hours a week on these projects.
Sure.
And get almost all of the same benefits and advantages that they do to doing it themselves. So now I would imagine you're working in the syndication model, and you have passive investors that come alongside for all of your projects. Can you tell the audience what type of projects you're working on? What are the kind of some of the specifics of those deals? Not deal specific, but like what type of structures do you use, and what kind of benefits could they get by working with you?
Sure. We try to keep it pretty simple. So we're primarily in 3 asset classes: rural land, industrial, and multifamily. The industrial, we're not syndicating those deals, and we're building out a portfolio, but that's kind of it. This is not an evergreen pipeline for us, so I'll kind of exclude that. For multifamily, it might be familiar to what you've seen with your audience. We do a 70-30 split. Investors own 70% of the deal. To your point about being able to participate and get most of the benefit, well, investors own 70% of the company. So, that's pretty good deal, and not a atypical syndication. So we'll go in, we're usually looking for a 7 pref for 2 investors, and then a 70-30 split after that. And we're targeting a 15 to 20 IRR on the deal on a 3 to 5 year hold. So probably pretty similar if you were to look at a multifamily syndication to what you've seen. I have always not liked complex waterfalls and structures, things like that. So we keep it really, really simple. So that's kind of the multifamily syndication business. If I had my way, we'd be buying a deal a quarter and selling 2 a year. Last 2024, we got into a couple of deals, didn't sell any. So a little bit slower year. That's everybody, but that's kind of a normal cadence for us. We buy 250 units a quarter, sell a couple, and just have slow and steady growth over time, net positive growth. And then we do rural land deals. So we'll completely different business model, but one I've fallen in love with. We'll buy large tracts of rural land, maybe 500 acres. We'll subdivide into smaller parcels, which creates a lot of forced appreciation. And if we do launch deals like that to investors, we just do it as a short-term debt offering, 12, 18 months. They're making 11, 12% on their money. There's no lender. We just kind of get in and out on these deals. And those have been attractive to investors that are like, hey, I don't know if I'm along for a 5-year ride on the multifamily stuff, but I can get 11, 12% on my capital, get it back in a relatively near term. People have seemed to like that. And so that is an evergreen model for us, where we'll keep buying land in Texas for the next 20 years.
Yeah, and you got plenty of land in Texas to
Sure
go
is.
after, I guess, right?
Sure.
So that's interesting. So you're doing 10 or 12%. Is it into a fund model, or is it?
We do have a fund, but if it's one-off land deal, we just do it deal by deal. Hey, this is deal A.
Okay.
We're buying this. It's 500 acres. It's an 18-month hold, in and out.
Okay. And so that's not providing cash flow throughout the hold period. It's just if
we actually treat it like it does provide cash flow. So we do a 10% distribution. And what we do is we essentially escrow it on the front end like a construction loan. Said, hey, we've got debt service costs on this deal. We're treating investors like the bank. The bank's going to want to see interest reserves. We do the same thing. We pay higher than the bank, but we are in the business of providing investments.
Yep.
So if the deal works for us to pay investors 12%, and we can continually have a new product to launch, a new investment product,
Sure.
that's a win for us. It's another menu item, and it's a
Hmm.
good return for investors. And frankly, I'd rather give the money to our investors than to the bank. So
Yeah.
that's kind of the way that we've approached that. But we do escrow the interest payments up front, and then as we sell parcels, that can recapitalize the company and kind of get
Interesting.
through that hold period. But yeah, people
Okay.
like it. It's a 10% annual distribution, and then a point or two on the back end.
Interesting. Okay. No, I like that model. It sounds like a development deal. I guess
Yep,
it's a value add deal. They're all value add deals to a certain extent.
correct.
Um, and is it first position
It is.
loans? They are. Okay. So
Yeah.
this is really not very risky at all. You've got a track record in doing this. So you've shown that you can cut these things up and make a pretty nice profit. And your investors get a great place to put money at 10 or whatever percent. So
Yeah.
that is fantastic.
Yep.
Is there a liquidity option to it, or is it held for the whole time while you have the
It's
product?
held
Or
for the whole time. Yeah. We just kind of set the expectation that, hey, we're going 12,
okay,
18 months here. If that is not enough time for your liquidity, it's not the right deal for you. It's
sure,
intentionally kind of from the outset is a short-term deal, which is
okay,
attractive to some folks versus say a equity syndication that's usually multi-year. So we kind of set the
yeah,
expectation up front that, hey, expect to have this money illiquid for this 12 to 18 month period.
okay, yeah, very good. And then so your value add projects, those are traditional value add where you're buying 70s, 80s, 90s, doing some exterior renovations, interior renovations, 2x equity multiple on the back end type of
Exactly.
performer.
Yep. It's vinyl plank, two-tone paint, plugs and switches, countertops, backsplash cabinets, a rebrand, maybe redo the office and amenity area, cure any deferred maintenance, tighten up operations. I mean, just the classic play that you've seen 100 times.
Love it. Love it. Yeah. Well, no, I think cookie cutter is great. I'd rather see somebody doing the same thing over and over and over and over
Right.
again than try to get creative and do something new. So with that, I think you mentioned you had 2,500 doors. You've been doing this 10 or 12 years. I'm guessing you've got a number of exits as well. What does that track record look like?
Yeah, we do have on the land side, we've got dozens of exits. These are typically $1 to $3 million projects, so we're constantly cycling in and out of those. On the multifamily,
Nice.
we've got 4 or 5 full cycle exits that we like to point to, where our average annualized return target. We've always kind of put 17 out there. Lately, we've transitioned doing a range. It kind of bothers me when I see um, an 18.244 IRR target. I'm like, just because the model said that,
Sure.
there's no way you're going to stick the landing on that in 5 years. But I get it. So
Right.
we've targeted 17. We've hit, as high as 20, 30 IRRs on some of these exits, right? But we
Sure.
try not to. We don't advertise that on deals that we're going into. We say, hey, we're targeting sort of that mid-teens average annualized return. Yes, here's deals that we've done in the past that have overperformed that. I think it's really important to point to projects where you've gone full cycle on a similar asset class. I mean, I think that's kind of the number one thing for a
Sure.
sponsor to have. Now, it takes years to get there. And so for newer sponsors, you got to figure something else out. But I think that's one of the most important metrics to say, hey, we're buying a 150 unit deal in San Antonio, Texas. Look at this 130 unit deal we did with the same business plan, and here were the results. So
Yeah.
really helps everybody to be able to point to those.
Love it. Love it. And is San Antonio the primary market where you're buying all your assets, or?
It is. Yeah. We've got one in San Marcos, which is just up I-35. It'd take me about 45 minutes to drive from my office downtown to get to it. Every time we've looked in other markets, it's a different cast of characters. The nice thing about San Antonio is it's kind of slow and steady. It doesn't get crushed in a downturn. It
Yeah.
doesn't have huge run-ups like a Phoenix might, but it
Yeah.
doesn't have these colossal downturns either. And it's kind of it's 7th largest city in the nation, but it just kind of feels like a smaller town. So
Hmm.
there's 5 brokers that I'm talking to. right, that sell
That's
all
it.
the stuff. And we go back years.
Yeah.
And so just kind of having that. And then there's 350 assets in the market that we would buy, and we know them all, and it's like, oh,
Yeah.
this one came back around. Yeah. Our regional manager used to work there 3 years ago. We're looking at a deal right
Sure.
now. Regional manager worked there 4 years ago. Great. Tell me
Yeah.
everything, so
I love it.
being okay with San Antonio and having that sort of home court advantage has been really nice. And it fits our deal flow. Like I said, in a perfect world, we're buying a deal a quarter. We've achieved that in the past. We're not trying to buy 20 deals a year, ever,
Yeah.
right? We just
Yeah.
want sustained growth, cycle through these deals, return capital, go out and do it again. So San
Got
Antonio's
it.
been the market. It's done well for us. And we want to keep buying here.
And so now I believe you guys are vertically integrated on
Yes.
property management and construction management as well, or
We sub out some of the construction to GCs on the larger projects. Some of it
okay.
we'll handle in-house.
Okay. And I'm sure you didn't start as a vertically integrated group.
No,
So
sir.
can you talk about that transition? Because I think there's plenty of operators out there that can use third party property management, and that is actually better than in house at times.
Could be.
Because property management's a difficult business with low
Yes.
margins. And
Yes.
I think a lot of people think they can do property management until they do property management. And they found out pretty quickly that it's much harder than what they thought. So, what was kind of the mindset behind bringing that in house when you did? And how quickly did you do that?
Yeah, it was more out of necessity. We had about 800 doors at the time. A couple of the assets were the third party management group, and we just got to the point where there was information we didn't have, like payables stacking up or bills not getting entered, and
Yeah.
then some liens starting to get filed, and we were like, man, we weren't even aware of these bills.
Yeah.
And so, certainly other people have been in that situation. But at that time, I'm looking at, okay, 800 units at $1,000 a month, rents, 3% of revenue to the management company. I'm going, that could support some payroll,
Yeah.
right? Now, the properties themselves pay the staff payroll, pay the property manager, pay the leasing agent, pay the maintenance. So that's borne by the property. So you're really then looking at the corporate level, accounting, leadership. And at that point, I said, we could just take the whole portfolio in house. Wasn't quite big enough, but this was in 2020, and I said, you know what? Let's launch the property management company.
Yeah.
Again, to your point, not a business I would opt to get in with a blank slate, but we've actually been able to run it with 10 to 12% margins, and we've
Wow.
grown. So it's a legitimate business now that generates a couple $1 million of revenue a year and decent margins. And we've got a great team. It's been a lot of trial and error getting there and swapping some players out. But at this point, I much prefer having the management company to third party. But it was started out of necessity, just saying, hey, we've got to let this third party management company go on these two assets. Is this an opportunity to maybe just spin up a brand new entity and do
Sure.
it? And it was, and it's been good. And now I wouldn't have it any other way. I mean, we only manage our properties. Everything from due diligence to disposition is radically improved by, I could send a Slack or a text to my VP of operations right now and get, the real answer on anything
Sure.
anywhere in the
Sure.
portfolio. And then to have it as another business line, I've got a ton of companies, but to have it as like a company that's big and producing revenue now, and it's another entity that's cash flowing. Hey, that's great.
Yeah.
So wouldn't recommend it unless you've got a portfolio to do
Sure.
it on. But in hindsight, it's worked out well for us.
So now, when you sell the assets, I know on the acquisition side, quite often people or operators will actually keep the on-site staff when they're buying acquisitions. So when you
Right.
sell these, do you end up losing employees as well, or does that fluctuate, or do you try to pull them to put them to new acquisitions that you're doing? How does that work?
It's very tricky because it's different when it's your company, and it's,
Hmm.
if it's third party management and you're selling an asset, okay, we're selling. See ya. You guys
Right.
figure it out. It's much more personal when it's an employee that's been with you for a couple of years. And so
Yep.
it's tough because I don't think people appreciate how difficult buying and selling real estate is if they're not in it every day,
Yep.
maybe like you and I are. Um, just because we got a contract to sell a deal, that doesn't mean we're selling. I mean,
Hmm.
there's 90
Sure.
days in there. There's 100 days of a lot of variables. So,
Sure.
it's like, hey, sometimes like, hey, let's not freak the staff out because we are entertaining offers on this property. How many
Okay.
times have we had offers that didn't result in a close? Most of the
Yeah.
time.
Yeah.
So that's tricky. Obviously, what we want to do, because we do have 90 to 100 days to close, is we really want to find a spot for you on another asset. We're already moving folks around internally. So
Sure.
leasing agent gets promoted. She's going to go run this new asset, or she's going to go run another asset. So-and-so is having another child. She's dropping out of the workforce. We're going to backfill her with a. So we already move around. I think the key to kind of employee management, and one of them is having enough portfolio to where if you sell an asset, they can be absorbed by other assets.
Yeah.
That's the ideal, is that we don't lose anybody that wants to stay.
Sure.
And having a big enough portfolio to be able to move folks around works. Or sometimes maybe somebody will come from the property side to come work in corporate. We just want to keep good people employed.
Yeah.
Sometimes a sale is an opportunity to say, hey, this employee wasn't so great, and so they're not staying on board. Somebody else
Sure.
that's got a track record and done well with us, yeah, we're going to find a spot for them.
Yeah. It actually gives you an opportunity to kind of force some turn as well,
Yes,
which I think is healthy for an organization. It's not always
agreed.
comfortable for the person that where the turn is occurring, but yeah, there's always a portion of the employees that it's probably time for them to move on. So
Yep.
yeah, that's interesting. Well, let's if we can, I'd love to get your perspective on the market, where we're at in the cycle. We got a little bit of that early on, but I'd like to hear your thoughts on the maybe next 3 to 5 years, maybe even longer, if you could share that.
Sure. I mean, it's anybody's guess on where rates are headed. We've got a new administration starting next month, so we'll see what happens there.
Do you,
Arguably,
do you mind if I dig into that a little bit though?
sure.
With the yield curve, like so rates have dropped, even though rates like the short term Fed rate has dropped, and the long term rates have actually gone up like 80 bips
Right.
since that's occurred. And there's a lot of speculation as to when we're going to start to see those start to align again. Do you have any specific thoughts about that? Or
I don't. I just,
okay,
what I like to say is I never saw 11 consecutive rate hikes coming over that short of a time horizon. Right.
sure,
And
sure,
so for me to make predictions about 2025, 2026 and beyond, I think is a fool's errand on my part. So
yeah,
it's tough to say. Everybody's watching the 10-year treasury and watching what that's done sort of this year.
yeah,
So we'll see. I would think, just painting with a broad brush, that the shock of the last 2 years, has been not necessarily absorbed, but normalized by the market. I mean, that was a
okay,
very disruptive set of rate hikes over a very short period of time
yeah,
that's caused a lot of pain in the market. Two sides of every coin, right? I mean, we touched on it at the top of the show. I think it's just going to create buying opportunities for those that are long-term players, or that have the capability to kind of stay in the game, and
yeah,
it will wash out a lot of others and create some buying opportunities. I think longer term rates, we could play guessing game on where that's going, but I think what we're looking at is population, right? Because
okay,
I think I have an answer for everything. I tell investors is I got an answer for anything you ask me except for population decline. If our
okay,
market starts losing people over time, I don't know what the answer is for that. If we've got
sure,
apartment buildings, um, and people are leaving the area, that I don't know how we combat that. So
right.
as long as population net migration is positive, I think that generally bodes well for housing.
Yeah. And all things point to net immigration into Texas for many,
Absolutely,
many years to come. So
absolutely,
not a concern from anybody I'm talking to, certainly in
right.
Texas, that's for sure.
That's right.
And actually, a question I didn't ask early on was: Are you guys a floating rate debt house, or are you a fixed rate
We've
debt
done
group?
both.
You
The
done
the
both? Okay,
floating rate stuff obviously caused a lot of trouble over the last couple of years. Some of those products are nice in that they've got some of your future funding included in it. right? So you got your rehab dollars baked in there. All things being equal, we've got some fixed debt at 3.5% for 10 years on some stuff. You're going, yeah, I would like all that, please.
Sure. Yeah, please
Would be
sign me
nice.
up.
That would be
Absolutely.
nice to have. Now, we recently refinanced some of our flex industrial product, and I took a floater on it. I'm like, this is a 5-year deal.
Yeah.
If I fix it now in the sevens, I'm going to refinance out. Do I think they're going up materially from here, from late 2024? I don't think so. Enough to
Yeah.
say, give me a floater on it, and maybe we'll write it down a point over the next year or whatever the case is. For the multifamily stuff, we'll look at it. The price of the rate caps, which is an insurance policy against a rising rate. Those have fluctuated so wildly. We were buying them for 20,000 a few years ago. They went up to $1 million. Now they're a couple 100,000. So I think floating can make sense in a couple instances. One, if there's not a huge shock to the system, like we saw during the 11 consecutive rate hikes, that can. So where are we now in late 2024? Are we going to see a similar rate shock to the system in the next handful of years? I don't think so. But you're buying your rate caps, which is an insurance policy for 2-3 years, where you've effectively got a ceiling on the rate. And if that can pencil for your deal, I think that, I think those are okay. And then there's some flexibility on those. Obviously, any real estate deal, best would be to have no debt. I just talked to a guy on my podcast. He's doing a hotel in Spain. I said, man, walk me through that. No debt. I said, that's the way to do it. If you can get yield and no debt, that's on the spectrum of things, that's the best.
That's ideal. Absolutely.
A lot of them, we need some debt. We need some leverage to get the returns up. So to answer your question, we do both. Fixed rates preferred. But the other thing on some of the fixed rate debt for consideration for investors and sponsors is the exit costs, right? You might be able to get really favorable agency financing, fixed rate debt, but your exit costs are almost prohibitive in some cases. So you've got to factor that in there. The nice thing about floating rate debt in most cases is you're paying a point at exit. So you can kind of get off the merry-go-round anytime it makes sense. And if you're doing a value add deal where you've got a game plan in year one to force some value, you do want the option to get off in 2 years if you can hit your numbers. So I do like that flexibility. And it's just another tool in the toolbox. And we're fans of using loan brokers that are in this every day and looking at all the lenders out there and advising us on which loan product to go with and kind of walking us through that process.
And do you see, and not to belabor this, but do you see, do loan brokers, are they generally all offering the same type of solutions, or do you see loan brokers that they just simply focus on fixed rate, or they simply focus on floating, or they like the 5-year?
My experience is that, their job is to have relationships with 500 banks, or to have a database of 500 banks and relationships with 50 or 100. Okay. And those are going to be constantly changing. So what my goal for a loan broker, if we're using them, is you need to be the master of everything that's happening in the market right now. And if there's a new product we don't know about, or a new lender in the marketplace that's going to get us better terms, you seek them out and get this deal done. So my experience is that they should have exposure to the whole suite of financing products that they can advise on.
One final question before we kind of go into kind of some of the fun questions here. But if you're in a fixed rate loan, let me back up. There seems to be this trend. We're seeing a lot of people that are doing this infinite return model where they do a cash out refi at year 5 or year 7, and then they continue to hold for 10 years plus.
Right.
If you're buying with fixed rate debt, is that option essentially off the table to do a cash out refi at year 5 or year 7? Can you do with the same lender do a cash out refi? Or
yeah, you could. I mean, if the value's there and you want to go through the refinance process and expense, yeah, sure.
Interesting. Okay. Yeah, I'm personally liking that model more and more for my own dollars because certainly when I got started, I loved the 2-year turns, double your money as fast as you possibly can. But now as I'm getting a little more sophisticated, a little more seasoned in the space, like having to find a new deal every X amount of years. If we've got a cash flowing asset, why don't we hold on to that cash flowing asset and just
Absolutely.
continue to live on it? So,
Yeah, and that's where the majority of the wealth is built over a longer horizon, right?
right.
You're not paying the taxes on it. If it's performing well, especially if you have your capital back, yeah, don't
Absolutely. Yeah.
if it ain't broke.
Yeah. Okay, good.
Yeah.
We're definitely in alignment on that. And certainly with your flex industrial, I'm sure that's what you're doing with those things as well, I would imagine,
Right.
right? Okay.
Yep.
Well, very good. Well, this has been informative. These conversations always go longer than what I initially tell them, so I apologize for that.
Oh, we're good.
Uh, but I do have a few other questions I'd love to ask just to wrap it up in kind of a fun way, if that's okay.
Sure. Yeah.
All right. Well, knowing that we are geared towards the newer passive investor, is there a specific educational resource that you like to suggest to the new passive investor that's either just getting started or trying to continue that education journey?
Well, I think the most important thing is to shake hands with people that are doing it. So that might be a meetup in your area, right? That's kind of the
Yep.
gold standard. I mean, the gold standard would be your father's a successful real estate investor and he can show you everything for 10 years.
Of course. Yeah.
I didn't have that. A lot of us don't have that. Outside of that, there really is something big about shaking hands or breaking bread with somebody that's done it. And, your local meetups can be a great way to do that. Obviously the podcast universe is amazing. You take advantage of all this windshield time or downtime. I mean, I cannot understand how I consume dozens of hours of podcasts in a week. I'm extremely busy. I work 12-hour
Yeah.
days and yet I'm still like, hey, I've listened to all my podcasts and they're all 2 hours long. How did I do that?
Yeah.
So the podcasts are great. And also just repetition, especially if you're new to this, some of these concepts can just seem so foreign and overwhelming. Once you hear it for the 10th time, um,
Right.
it helps. And then look at real deals, right? Get on your list, see what deals Randy Smith is putting out, read the OM, watch the webinar, review this. You're going to start to realize after you've reviewed 10 of them that, boy, there's really a lot of similarities. There's a
Yeah.
pref and a split. Business plan's kind of the same here. And so just exposure to actual real deals, I think is very helpful. And look at a bunch of deals before you ever pull the trigger. Just get
Great
acclimated.
advice.
So,
Yeah.
I think, and then specific books, I mean, there's your Amazon bestseller in commercial real estate. Whatever that happens to be is probably a pretty good spot to be if you're a
Sure.
book reader. But you've got all those resources and you've got more resources now than ever before to start tapping into this stuff. But I would encourage anyone that's interested to actually go out and shake hands with somebody and get to know somebody in the space. And that's just going to something about meeting in person connects us in a way and kind of makes it more real for you.
I couldn't agree more. Great advice. And oddly enough, I've not heard that in the 200 plus interviews that we've done. Nobody's ever said that. There's always a book or a podcast, but great advice. Just get out and meet people. No better way to learn the business than to get in the field, go walk some properties, even if that's an option.
Absolutely.
Good stuff. All right. So you mentioned podcasts. Any favorite podcasts you care to share with the audience? Doesn't even have to be real estate related. I'm currently loving. There's an All In podcast, and I love listening to economics. I never thought I'd be that guy, but I'm that guy now.
Right.
But any podcasts that you're loving lately?
Well, when I started out, I would not when I started out, but I was earlier in my career. I listened to Joe Fairless podcast. I would listen to any multifamily real estate investing podcast, Rod Cleef, those kinds of things. What I found now at this point in my life is I'm living that every day. So I'm not, trying to get into that. I remember the Old Capital podcast was really, really good.
Absolutely.
I used to listen to that a lot. So those are good ones. And your podcast course, we've got a podcast, DJE podcast. So, you can find those. And it was so instrumental to me going back to that 2.5 years when I was working and burning the candle at both ends. I actually stopped associating with anybody at work because they would complain about stuff with no intention to fix it. It drove me bonkers. So I would literally go to lunch by myself every day, AirPods in, sit at the lunch counter at Chili's and just consume a real estate podcast. So, hundreds, thousands of hours of that. I think really was formative. Now I listen to podcasts to disengage. So I'm going to be listening to podcasts about comedy, about what really how did the pyramids really get there? I mean, just
Sure.
bizarre
Yeah.
stuff that
Random
just
stuff.
really
Yeah.
makes you think. So I've gone down a rabbit hole of just the most bizarre podcast or just comedy to just turn it off. Right? Give me
I
some
love it.
noise and so I use that now as more of disengagement device because I'm so engaged at work. And really at this point, I'm big into learning and I'm a lifelong learner. What I find now is running a company with close to $400 million in assets, 70 employees. There's no better learning experience than every day
Sure.
at
You have
work.
it every day. Yeah.
Yeah. So,
Yeah.
I had done a bunch of masterminds early in my career. Now the thought of flying to Las Vegas for a weekend to talk about asset management on multifamily, I'm like, dude, I'm doing this all day, every day. So
Right.
I'm gonna,
Right.
so it's more about, disengaging on the podcast stuff for me these days.
Love it. Love it. Very good. All right. Well, due diligence, we talk a ton about. Are there due diligence questions you think passive investors should be asking that maybe they aren't?
Yeah. I mean, never seen a bad deck, right? Never seen a bad pitch deck. So just know that, right? I
Yeah.
wouldn't take it at face value. Know that every assumption the operator is making is an assumption. So, I think it's easy early on getting into real estate to, you've got the model and how the model's working. It's like, hey, there might be some surprises with insurance or taxes or rate hikes or whatever that, it's more important to be nimble and have cash and a good team to be able to ride out whatever's around the corner than it is to perfectly. I've seen pro formas, from these guys in New York, 60-month pro forma by month, every line item. So you've got your common area utilities monthly line item modeled for 60 months. I'm telling you,
Sure.
that's going to be wrong a little
Right.
bit out. So I
Yeah.
would say, understand that there's never a bad investment deck. But the number one question, and this is fairly obvious, but dear sponsor, thanks for sending me this deal. I'm considering investing in it. Can you show me a deal very much like this that you've finished, right?
Yeah.
You got it, you did it, you finished, and it did what you said it was going to do. And that's obviously biased towards more experienced sponsors. And,
Sure.
everybody's got to get started somewhere, but that's the number one thing for me. If I'm going to invest passively in a deal, and I invest passively in a lot of deals, it's, is this a brand new idea you had, or is it, I feel much better about, we're doing our third XYZ deal. Oh, okay. And we sold the first one, or we sold the first two. Here's what it did. That's an entirely different level of comfort that is very hard earned, right? If somebody's pointing to, a vineyard that they developed and sold and it did X, and they're doing another vineyard, just as a stupid example, I feel a lot better than some guy had an idea to do a vineyard. And so I think it's the number one thing. Can the sponsor point to a similar project that that's done?
Perfect. I love it. Yeah, I agree with you. Like, everybody's got to get started. They just don't have to get started with my money, right? There's plenty of good opportunities out there. That's
I also, on the other side of the spectrum, I kind of take issue with people on LinkedIn that say you should invest with anyone that hasn't been investing since 1985. And it's like, well, okay. I mean, I know you're going to say that because it's to your advantage that you've been in business for 40 years, but that means literally 90% of the operators out there don't make that threshold. I get it. So I don't want to be that guy that's saying poo-pooing new sponsors, but I love what you said. You got to get started somewhere, maybe just not with my capital. That's what
and honestly, those guys that have been doing it since '85, they probably don't need my money anyways. Honestly,
exactly.
Right? They're the guys that oversubscribe with the conversation at the country club. That's it.
That's true.
Right?
Yep. Good point.
So, all right, a couple of fun ones here to wrap it up. You and I are both in a group called GoBundance, so we talk a lot about bucket list items. Do you have a recent bucket list item you've checked off your list, or one you're hoping to soon?
Yeah, I do. It's not a singular item that, hey, I've got to achieve this. I've been blessed beyond measure, enough blessings for 1,000 lifetimes. But I would say that aviation has changed the way my family operates. So I'm a helicopter pilot. I'm an airplane pilot. And, I'll just give you an example. Is like a mini dream come true bucket list. And we have them on a monthly basis. Last Saturday, my wife and daughter were doing cheer stuff. They're doing the girly stuff. My sons and I jumped in the helicopter, flew out to one of our ranches, hunted, had a great time. They got deer. We flew back, and we're back at the house for dinner. And that's kind of an adventure that we might take a whole weekend under normal circumstances, and maybe because of that we wouldn't do it. Because we have aviation, and we call it the time machine. We can do. I think I'm literally 4xing the quality of adventures I have with my family because of aviation. And so it's not a specific bucket list item, but having aviation in our lives has just allowed us to have so many adventures in this precious time while my kids are still, in the house. So that's it for me.
Fantastic. What an amazing experience. Another GoBro at a recent event brought us up to circle around the Grand Canyon, and we went and had breakfast in Sedona.
So cool.
And it's like, how does that happen?
So cool. I love it.
We're just going to run do this in the morning. So yeah, very cool. All right. Final question that I like to ask everybody, because we are a passive investing community. If you had $100,000 that you had to invest today, but you couldn't put it in your own deal, where would you put it?
Yeah, I would probably look for, frankly, for me, I'd probably look for a development deal. I'm not looking for the cash flow. And it's not a commentary on the development market right now, just painting with broad strokes. I've done some development deals where you're targeting a little higher IRR. Is obviously no cash flow, but that's probably where I put $100,000 right now. Or, syndications too, multifamily, these are all syndications. A multifamily syndication that can be had at a good basis right now, where you believe in the operator, the market, and the game plan, and they're buying it at, 60% of what stuff was trading for recently. I think that makes sense too. So that's where I'd put my $100,000 development deal or a good basis multifamily deal.
Yep. And I think what you said earlier was key. You're not looking for cash flow, so you're looking to grow that capital, the equity multiple on that piece. So yeah, very important point there.
Yep.
Well, very good. Well, Devin, this has been a lot of fun. We always go down paths that I'm not expecting when these things start, but this was a fun conversation. I feel like I learned a lot, and just really appreciate you taking the time to spend with us today. Thank you.
My pleasure. I enjoyed it. This is great. I appreciate the invite.
Awesome. All right. To the audience, as always, we encourage you to continue your education journey in passive investing. But more importantly than that, we encourage you to make the decision to invest in your first passive investment deal. Both Devin and I are convinced that once you do, you'll just wish that you had started that much sooner. So again, thanks for joining us again today. Be sure to join us again next Thursday for another great episode. And don't forget to like and subscribe on whatever channel you're listening to. Thanks so much.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.